Namaskar, my name is Shishir. Welcome to this episode of podcast on Year Ender. 2024 is soon going to be the part of history and so as all the good and bad news of this calendar year. Now there are a lot of expectations from the new year 2025 as well as the fiscal year 25-26. What are those expectations and what the government should do to talk about all those things? We have with us Sonal Varma, joining from Singapore directly, and she is Chief Economist with Nomura. Thank you, Sonal, for joining us.
Thank you, Shishir.
Let me start with the very bad news. What has been the biggest disappointment of calendar year 2024?
I think the current stagflation light mix of low growth and high inflation, which basically restricts any policy flexibility to respond. I think that's been the biggest disappointment.
Okay. And there's a big debate on consumption. Even the monthly economic review by Finance Ministry talked about lower consumption in urban area. Many of the FMCG companies are also saying that the consumption is down. How do you see this story, and what could be the basic reason behind this slowdown?
Yeah, I think, whenever we think about the macro parameters, we think about what's the underlying trend and how the cycles are moving. So similarly for consumption, post-pandemic, actually, the pent-up demand was very strong and above normal. And what we've seen this year is essentially that pent-up demand has faded and we've sort of normalized to some trend, which is below the range we had seen in the last 2 years. But on top of that, there are certain, I would say, cyclical factors that are impinging on the trend also. In particular, the credit side, the availability of consumer credit has moderated, which was basically a regulatory decision to contain macro-financial stability risks. Now, some of these loans were being used to, purchase maybe low-ticket consumer discretionary items, and therefore this has played some role. Second, the income growth seems to be moderating. So when we look at we in India don't have very good proxies for urban wage data, but we use certain estimates, for instance, the staff and salary expenses of listed non-financial companies. That was growing in double digit, but has now moderated to between 6 to 7% on a year-over-year basis. So if you adjust for inflation, actually the real increase is less, but even on a nominal basis, salary increases have come down. And I think third is the extent of job creation has been much slower in this recovery cycle as well. So I would say those are the main reasons, and of them, the moderation in income growth and slower job creation, I would say, are the primary factors.
After all these bad news, now coming to the good news. The good news is that from October onwards, we are seeing some improvement in high frequency economic indicators, whether we talk about PMI, whether we talk about manufacturing growth and all those things. How do you read these numbers in last 2 months, and how do you see that the growth projection for the entire fiscal, which the government is expecting between 6.5 to 7%?
Actually, I would characterize the data since October also as mixed. So the month of October on consumption-related indicators was good because of Diwali festival falling in this month. But if you look at the numbers in November and some feedback that's coming in from December, retail demand, retail auto sales have actually disappointed again. So the kind of spurt we had seen during the October festive season doesn't appear that it has lasted. So I think it's still looking like October, December quarter should be better than the September quarter GDP numbers. But the extent of growth rebound we see maybe still subpar. And I think, right now, sort of the discussion in India is how much of this slowdown in the second quarter is transient, and as government spends and rural comes back and everything goes back higher, we need to remember that there are other factors that are at play. Credit growth continues to slow down. Consumption on the urban side continues to moderate. Monetary policy, in our view, is actually restrictive. Private capex hasn't really picked up. External demand is looking a bit wobbly. And therefore, if you put the aggregate picture, our own view is India is already in the midst of a business cycle slowdown. And we think this is likely to last a bit longer. So we are, I would say, a bit more cautious right now on the forward growth outlook. And for FY25, our real GDP growth projection is around 6%.
Oh, that's too low. I mean, if we take the what RBI had said or what other agencies have said, even the government is saying between 6.5 to 7%. Of course, the number which we'll know next month only. Now coming to the budget, which is the third budget within 12 months. And what are the key things which you think that to change this cycle, or if I remove the word good indicator, which I mentioned in my question, to the mixed set of indicators. So how to go into the positive aspect? What are the things which you expect from the budget?
Yeah, I think one shouldn't place too much emphasis on one budget to rescue everything at one go. And I think over the years we've seen some very good budgets, which on a cumulative basis should do their job over a period of time. In terms of specific challenges for this budget, I think the number one issue is the slowdown in consumption. And what can we do? Should we do, and what can we do to try to reverse some of this slowdown? There are many ways to address this slowdown. There are potential ways to increase real disposable income for households, for middle income consumers, where stress appears to be there through tax tweaks, etc. So I would say that is number one. Second is, in the last 3-4 years, government has basically significantly increased its capex to GDP ratio from 1.7 to now at 3.4% of GDP, with the intention to crowd in private investments. And that hasn't really played out materially. And if private consumption is slow, then capacity utilization is not at that level where you will see private capex pick up. And in FY25, the allocation of loans from center to states on capex, that amount has also been undershot. So net, what it means is that at least from the central government side, they will still need to keep its capex to GDP ratio at a higher level because we haven't seen that crowding in actually come through as yet. So I think the biggest backdrop for this budget is essentially the moderation in growth that we are seeing right now. And to that extent, some counter-cyclical fiscal policy measures are still needed. That said, we still are looking to move towards a gradual fiscal consolidation. So, FY25 target of 4.9% of GDP, we think actually it could be even better than this because the capex spending has not been as much. And the government can actually move to less than 4.5% of GDP while making some allocations on the consumption and the investment front. So I think, this balance of consolidation while giving some targeted growth support is probably the biggest backdrop for this budget. And not to forget, like 2025, we will have Trump 2.0 come in. And it is expected that external demand is going to be softer. And therefore, most countries, including India, need to buttress their domestic demand in that environment. The final thing I would add is, we have started integrating on global value chain integration. There's been a lot of imports coming in from China, which is hurting domestic companies. We have some, inverted duty structures in place. So I think making some corrections there could probably also be of importance.
In fact, you answered my next question. That was about the Trump administration, which is going to take power in the month of January. One question is critical in this budget would be that 4.5%, as announced earlier, that the fiscal deficit should be at 4.5%. How possible you think this 4.5% in FY26 would be?
Yeah, I think it's very possible. And I mean, essentially, the starting point itself, we think, is going to be better. So FY25 fiscal deficit target of 4.9% of GDP. The capex undershoot, in our view, in FY25 will be at least a trillion INR less than what was in the BE number. And on the revenue side, it's a bit of hit and misses, between RBI dividend being better, but certain taxes being lower. But on the whole, we think the budgeted fiscal deficit can actually be better than this 4.9. So the jumping board for FY26, therefore, itself is lower. Then if you look at like specific components, like even on the capex to GDP ratio, which is at, let's say, 3.4% right now, we've already seen a significant increase in capex allocation from the government over the last 3-4 years. And I think now the objective would be more to keep capex at the current level of GDP as a share of GDP rather than continue to increase it at 25-30% year over year, which is what we did historically, but we're already staring at a very high base. So I think capex to GDP ratio itself is going to be stable. So if you have a combination of better starting point, nominal growth assumptions of, let's say 10% or so, capex to GDP stable, I think in that overall framework, it should not be a challenge. Obviously, a lot depends on how growth plays out through the course of FY26, because that will determine how actually tax buoyancy plays out in the next 12 months.
Okay. Sonal, my final question to you. I started with one of the biggest disappointment of calendar year 2024. Now, if I end with that, what could be the one big thing which you expect in 2025 calendar year?
Because positive or negative?
It's all up to you.
I think both positive and negative. So I think let me start with negative so that I can end on a positive note. So the biggest risk we see right now is actually on the growth front for India. And I think, lots going on in terms of the impact of monetary policy, impact of this, credit tightening, impact of pent-up demand fading away, nominal incomes coming down, private investment soft, external soft. So we do think that, our potential growth is 6.5 to 7. Our aspirational growth is close to 8. We think next 6 to 12 months, we will fall short of even the trend growth. So that would be the biggest risk in our view. And therefore, at a public policy level, the question is, what is the right tool to address this slowdown is something we will be monitoring. On the more positive side, the commodity price outlook under Trump 2.0 could potentially be positive for India. I mean, if indeed US sort of moves towards increased oil production, then we could see lower oil prices, which from India's perspective means that that could be a source of disinflation going forward. And even the Reserve Bank of India, which has been very constrained in reversing its monetary policy course, we think the extent of policy easing is going to be a positive surprise in 2025.
Okay, on this positive note, thank you very much, Sonal. It's always pleasure talking to you and wishing you and your team a happy new year.
Thanks very much, Shishir, and Happy New Year to you.
Thank you.